Guys, the last time I saw interest rates this high was right around the 2009 financial crisis. Back then, you had banks like ING and HSBC offering 5% interest on their online only savings accounts. We are pretty much back in this situation now with Treasury bills offering about 5%. Now, the stock market was the only game in town for the last 10 years or so because interest on bonds and savings were so low. That has changed, so there is even less reason for some people to be in stocks now. We are now at the point that treasury bills yield more than the S&P 500 earnings yield. So let's take a look at what is going on, and I will explain what earnings yield is and why it is important for investors. So this Bloomberg article says treasury bills offer stock like 5%. So, for the first time in nearly 2 decades, investors can earn more than 5% on some of the safest debt securities in the world. That's competitive with riskier assets like the S&P 500 index. Now, it says there's a small catch. The US Treasury bills have become less safe because without an act of Congress, the payment may be delayed. Now, this is all political theater because no person in the government is not going to kick the can down the road. We've been doing it forever. And so raising the debt limit ceiling nonsense is going to happen anyway, no matter what. So I would not be worried about this at all. But so here they say 6-month Treasury bills became the first US government obligation since 2007 to yield more than 5%. Meanwhile, the clock is ticking to raise the federal debt limit, blah, 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 warning the government will otherwise run out of cash. I've seen this movie before and I know how it ends. So I am not worried about that. But here's the interesting part. With returns on 6-month bills now a whisker away from the earnings yield on the benchmark equity index, the S&P 500, it's a risk investors appear willing to take as weekly bill auctions continue to draw strong demand. Cash has become king. At such higher rates, these cash like instruments become a much better risk management tool in your portfolio than other things. So, if you put 50% of your portfolio in T bills and the rest in equities, then your portfolio is better balanced. So looking at a chart of 6-month treasury bills going back to 2007, you see it was about 5% here and then dropped to basically nothing after the market crash. And it stayed that way for most of the rest of the decade until the taper tantrum over here, where the Fed tried to raise interest rates, the market started falling, and so they lost their nerve and went back down to essentially zero. But just now, in the last year or so, we are up so much that we are now at these levels here. Now, when you compare 6-month Treasury bill yields to the S&P 500 current earnings yield, you'll see that they are essentially the same now, and that hasn't been the case since about 2001. Now, what is the earnings yield? Well, you know the price to earnings ratio. If you flip it around, the earnings to price, that is the earnings yield. So if the S&P 500 has a price to earnings ratio of 20, that means it has an earnings yield of 5% a year. In other words, you're making 5% on your money a year, and in 20 years, you will make back what you invested. Now, during the great financial crisis bubble, the S&P earnings yield and the 6-month Treasury bill were close, almost equal. But when the S&P tanked, the earnings yield went up to 10% and the T-bill yields went down to almost zero. So just looking at this, S&P was very cheap compared to Treasury bills. And that has stayed the same for more than 10 years until now. And so this bottom chart here is the spread between the earnings yield on the S&P and the 6-month T-bill. And you see the spread was about 10 percentage points up here. Now it is 0 percentage point. And so all of these people that are kind of risk averse but want some interest or some yield, they had to be in the stock market all this time because the difference between T bills and the S&P earnings yield was a lot. Now it is zero. So a lot of people may prefer to be in treasury bills because they are risk-free and they are yielding the same as the S&P, and they may even start yielding more unless of course the S&P starts falling to levels like the great financial crisis, and so in effect the earnings yield goes up because the price to earnings ratio goes down. So, in this age of uncertainty about how much higher rates could go and the amount of investors leaving stocks to get a better risk free yield in treasury bills, and also the Fed not only not doing quantitative easing, but actually doing quantitative tightening, the idea that we will be back to the races in the stock market any day now does not seem to be very likely. It's your money, invest accordingly.